Bootstrapping earnings per share is one of the many reasons why a company may undertake a merger and acquisition exercise. Let's go through what is the bootstrap effect, and why it might be bad for a firm if that is the only reason driving an M&A exercise. Bootstrapping. Bootstrap effect or bootstrap earnings effect refers to the short-term boost in the earnings per share of the acquirer company when it merges with the target company, even though there is no economic benefit from such combination. Let me explain how this works. This happens when the acquirer, who is trading at a higher price to earnings, calculated as share price divided by earnings per share, acquires Target Co., which trades at a lower price to earnings ratio using a share swap deal. This means acquirer will have to pay for the market value of the shares of Target using its own shares. If acquirer acquires Target through stocks, there will be fewer combined shares outstanding post-merger, since earnings remain the same but there are fewer shares of stock. The earnings per share ratio increases favorably. Investors may not understand the reason behind the increase in earnings per share. Instead of getting to know the underlying reason behind the sudden surge, investors may believe the earnings per share increased because of the synergy created through the merger, resulting in the increase in the value of the post-merger stock. Companies may enjoy this temporary boost in stock price, but the bootstrap effect generally becomes apparent in some years. In order to sustain the earnings per share ratio at an artificially surged level, the company would have to continue to play the merge and expand strategy by aggressively acquiring companies at the same rate. Once a merger and expansion spree comes to a halt, the earnings per share will decrease and the stock price will follow suit. Let's walk through an example here. Looking at the first 3 rows of data, we can see the market value and share price of both buyer and target. Market value of equity is basically derived by multiplying a company's number of outstanding shares with its share price. In the next 3 rows of data, we have the profits and EPS of both buyer and target. Again, earnings per share is basically calculated by just taking net profit divided by a company's number of outstanding shares. Once we have the share price and earnings per share, we can now calculate the price to earnings ratios of buyer and target by taking the share price and divide that with the EPS. As you can see, the buyer P/E ratio is much higher than the target's P/E. Simplistically, let's assume an acquisition scenario where the buyer acquires the seller at its market value of $3 million. And no premium to the market value has been paid. And let's just assume that the acquirer uses its $100 priced shares to pay for the $3 million acquisition. How many shares would acquirer need to issue? The maths is simple. At $100 per acquirer shares, to pay for the $3 million in target's share, we divide $3 million with $100 per share to find out the number of shares the acquirer need to issue, which is 30,000 shares. So, as a result of the merger, acquirer's shares will increase from existing 100,000 shares to a total of 130,000 shares, including 100,000 old shares and 30,000 new shares. But remember, the acquirer earnings will increase by a larger quantum than the shares increase, as the acquirer will get a 100% of the target earnings. Hence, the post-merger earnings of the merged entity will be $850,000, which is 600,000 profits of the acquirer plus the 250,000 profits of target. Now, all we need to do is to calculate the post-acquisition EPS of the acquirer. We take the post-merger earnings of $850,000 and divide that with the acquirer's new share base of 130,000, which is $653. It can clearly be seen that the post-merger earnings per share of the acquirer is greater than the acquirer's earning per share before merger, which is mainly due to the effect of increase in total number of shares of the post-merger entity. That is not proportionate to the increase in acquirer's post-merger earnings. Again, investors may not understand the reason behind the increase in earnings per share allowing the company to enjoy temporary boost in share price. But this will generally become apparent in some years. So this should not be the only reason which drive any big strategic acquisition decisions.